In 1720, one of the smartest men who ever lived lost everything. That man was Sir Isaac Newton, the genius who gave us gravity and calculus. He watched his entire fortune just evaporate in a few weeks. What happened? He invested in something called the South Sea Company, a trading firm that promised unbelievable profits. At first, he was smart. He made some money, sold his shares, and walked away with a nice profit. But then he made a mistake. He saw everyone around him getting richer and richer. The stock kept climbing. His friends, his neighbors, they were all doubling their money while he sat on the sidelines. So, what did Newton do? He did what millions of smart people have done throughout history. He jumped back in. He invested even more money than before, totally convinced the good times would keep rolling. A few weeks later, the bubble burst. The South Sea Company collapsed, and Newton lost what would be $20 million in today's money. He famously said he could calculate the motion of heavenly bodies, but not the madness of men. This is a story about money and mistakes. Not small mistakes, like forgetting to pay a bill. We're talking about huge, world-changing blunders that wiped out fortunes and toppled empires. And here's the scary part. The people who made these mistakes weren't fools. They were kings, presidents, and brilliant bankers. They failed because money does something weird to our brains. It messes with our judgment. It cranks up our fear and our greed. It convinces us that this time is different, even when history is screaming that it never is. Now, understanding these mistakes won't automatically make you rich, but it might just keep you from becoming poor. And when you're playing the long game of finance, avoiding total disaster is way more important than chasing a huge win. The greatest investors didn't win by being right all the time. They won by not making the mistakes that destroy everyone else. So let's start with the first, and maybe most common mistake, believing that prices can only go up. It sounds ridiculous when you say it out loud, right? Of course, prices can fall. But when you're in the middle of a boom, with charts going up and everyone feeling confident, that simple truth just disappears. The South Sea bubble wasn't a one-off thing. It was a pattern that has repeated itself for 300 years. The details change, but the psychology is always the same. Back in the 1630s, the Dutch went crazy for tulips. A single flower bulb could cost more than a house. People borrowed massive amounts of money to speculate on these flowers. When the prices crashed, fortunes vanished overnight. Families that had been wealthy for generations were suddenly broke. The flower that once symbolized beauty became a monument to greed. Fast forward almost 300 years to America. By 2006, home prices had been rising for so long that people forgot they could fall. Banks invented complex financial products all based on the idea that real estate would go up forever. Everyone believed the myth, housing never goes down, until it did. When that bubble burst in 2008, the damage was massive. Millions lost their homes, and the whole world plunged into the worst economic crisis since the Great Depression. The lesson isn't to never invest in a rising market. The lesson is to always ask yourself one simple question. What happens if I'm wrong? If your entire financial plan depends on prices going up forever, you don't have a plan. You have a prayer. The second huge mistake is just as tempting, believing that debt is free money. Throughout history, people and entire nations have borrowed their way into ruin by confusing access to credit with actual wealth. They are not the same thing. Debt is a tool. It can build things up, or it can tear them down. Debt also has a hidden weight. Interest piles up and payments become due. What seemed easy to handle in good times becomes a crushing burden in bad times. The most shocking example of this was in Germany after World War I. The government had massive war debts it could never pay. So what did they do? They decided to just print more money. At first, it seemed to work. But printing money doesn't create wealth, it just dilutes it. Prices started rising. Then they rose faster. By 1923, Germany was in a state of hyperinflation. A loaf of bread cost billions of marks. People would get paid with a wheelbarrow full of cash and rush to spend it before it became worthless by the afternoon. The middle class was completely wiped out. And from that economic chaos, something much darker began to grow. Every bankruptcy, every foreclosure starts with someone who thought their future was more certain than it really was. The third mistake is trusting the wrong people with your money. This sounds obvious, but the biggest financial criminals don't look like villains. They look like saviors. Think of Bernie Madoff. He ran the largest Ponzi scheme in history, stealing nearly $65 billion. His victims weren't clueless. They were sophisticated investors and charities. Madoff succeeded because he understood psychology. People trust consistency more than they trust transparency. His returns weren't flashy, they were just steady. Year after year, his investors got reliable gains, and that consistency was the trap. No one asked how he did it because no one wanted to rock the boat. The money kept flowing. When the scheme finally collapsed in 2008, the damage was catastrophic. The lesson here is that you have to verify. A good reputation isn't a guarantee of honesty. The more someone tries to stop you from asking questions, the more questions you should ask. The fourth mistake is maybe the most painful, because it's not about a villain or a bubble. It's simply the failure to act. More fortunes have been lost through indecision than through bad decisions. Just look at Kodak. For most of the 20th century, Kodak asterisk was asterisk photography. They completely dominated the market. And then, digital photography came along. Here rests the tragic part. Kodak invented the first digital camera in 1975, and engineers showed it to the executives. They saw its potential, but they also saw it as a threat to their profitable film business. So what did they do? They buried it. They told the engineer to keep quiet. They thought they could deal with digital later. But later never came on their terms. Competitors developed digital cameras, smartphones put them in every pocket, and the film industry collapsed. Kodak, the company that could have owned the future, filed for bankruptcy. The world doesn't wait for you to be ready. The failure to act is a decision in itself, and it's often the most expensive one you can make. The fifth and final mistake is the most subtle. It's the belief that you are different. That the rules that apply to everyone else just don't apply to you. When Isaac Newton jumped back into the South Sea bubble, he thought his intelligence made him immune. When homeowners borrowed against their houses in 2006, they thought their neighborhood was special. When Kodak executives dismissed digital, they thought their company was too big to fail. In every case, the mistake wasn't ignoring the risk. It was the belief that the risk was for other people. This is the exceptionalism trap. It whispers that you're smarter, your timing is better, and you'll see the danger coming. But financial gravity pulls everyone down the same way. So what connects all these mistakes? It's not just greed or stupidity, it's overconfidence. The antidote to overconfidence is humility. A real, honest admission that you don't know what the future holds. This doesn't mean you should be scared to do anything. It means you should be prepared. It means building a margin of safety into your decisions, diversifying your investments, and keeping some cash for emergencies. The purpose of studying these failures isn't to scare you. It's to help you recognize the warning signs. When you feel certain an investment can only go up, remember Newton. When debt feels like free money, remember those wheelbarrows in Berlin. And when you start to feel like you're the exception to the rule, remember that's what they all thought, right before everything went wrong. History doesn't repeat itself exactly, but it definitely rhymes. Learn the patterns and you'll have the only edge that truly lasts. Thanks for watching. If you found this helpful, be sure to like and subscribe for more content. See you next time.